looking at yesterday's close, Grab Holdings dropped down to $4.08.
Yeah, pretty sharp drop.
Right, and we were seeing sell signals across the board, a falling short-term trend, and yet somehow some valuation models out there are just screaming the stock is 63% undervalued.
It is a wild disconnect.
It really is. So is this recent dip a massive buying opportunity, or are we staring down a classic value trap? Welcome to the deep dive. We're dissecting a massive stack of financials, technical data, and insider activity on Grab Holdings to figure this out.
There is a lot to unpack here.
Oh, absolutely. And just a quick reminder to everyone listening, if you want us to keep pulling the curtain back on these market mechanics, dropping a like, subscribing to our YouTube channel, and leaving a comment with your feedback is compulsory if you want to keep getting these insights.
Yes, please do that. But before we go a single step further, I need to jump in and make something crystal clear.
Go for it.
Everything we're discussing today is strictly for educational and informational purposes. We're mapping out the data, debating the mechanics of the market, but absolutely no financial advice is being given here.
Right. You have to do your own research.
Exactly. We're just two people analyzing the data.
Yeah, we're just here to make sense of the noise. And honestly, to make sense of the noise around Grab right now, we have to look at this through the lens of what we could call the transition penalty.
The transition penalty, yeah, that's the perfect term for it.
Right. Because Grab is caught in this profound identity crisis. It's trying to transition from a hyper-gross, money-burning startup into, well, a mature, profitable dividend payer.
Which is an incredibly awkward phase for any tech company.
Extremely awkward. And the market is mercilessly punishing them for being in that in-between phase.
Well, that transition penalty is basically the central narrative driving almost all the volatility we're seeing. So let's actually look at the engine of that transition, the 2025 financials.
The big milestone.
Huge milestone. Grab finally reported its first full-year net profit in FY 2025.
Which is crazy because for years, the whole story around Southeast Asian super apps, the companies doing ride-hailing, food delivery, digital payments, the story was that they were structurally incapable of making money.
Yeah, people literally called them cash incinerators.
Exactly. But the 2025 income statement just breaks that narrative entirely. Revenue hit $3.37 billion.
Which is, what, a 20% jump?
Yeah, a 20% jump from the $2.8 billion they did in 2024. But more significantly, net income came in at $588 million.
That is a massive turnaround.
Right, from a $284 million loss the year before to a $588 million profit. It's a tectonic shift. Even their operating income finally crossed into the green at $65 million.
Which is huge because operating income isolates the core business right before you strip away the taxes and interest. It proves the core business engine actually works.
Right. It's like they finally graduated, moved out of their parents' basement, and got a real job.
That's exactly what it feels like.
But here's the thing. If you are a retail investor holding Grab at, say, a $5 average right now, seeing this $588 million headline profit probably makes the current $4.08 share price feel incredibly confusing.
Oh, I'm sure it's incredibly frustrating to watch.
Especially when you look at the balance sheet. They are sitting on a war chest of $6.804 billion in cash and short-term investments.
Up almost 21% year over year.
Yeah. And operating cash flow is a very healthy $430 million. And this is where the narrative kind of snaps for me. When you look at the financing cash flow, and they generated nearly $1 billion there, bolstered by a $1.5 billion debt issuance in 2025.
Ah, the debt question.
Yeah, because, wait, if you have almost $7 billion sitting in the bank,
yeah,
and your operations are finally spitting out cash, why on earth are you taking on that much debt right as you become profitable?
I know. It looks completely contradictory to anyone managing like a normal household budget.
Right, if I have cash, I'm not taking on a loan.
Exactly. We're conditioned to think of debt as a solution for a lack of capital. But in corporate finance, especially at this multi-billion-dollar scale, debt is a structural tool. It's not a lifeline.
Okay, so how is it a tool here?
By issuing debt when they are newly profitable, Grab is actually protecting that $6.8 billion cash mode. If they drain their own cash reserves to fund, say, their strategic moves...
Like the geographical expansion into Taiwan.
You're right, the Taiwan expansion or building out their fintech infrastructure. If they use their own cash for that, they leave themselves highly exposed to sudden macro shocks.
So it's about shifting the risk to the lender, rather than eating into their own safety net.
Precisely.
Wouldn't the interest payments drag down that hard-won profitability we just talked about?
Well, this comes down to their weighted average cost of capital. When a company proves it can generate positive operating income, its credit profile just changes overnight.
Lenders see them as less risky.
Exactly. Lenders are suddenly willing to offer highly favorable interest rates because the risk of default has plummeted. So Grab is basically leveraging its new profitability to borrow cheap money.
Oh, I see.
Plus, taking on debt doesn't dilute existing shareholders the way issuing new stock would. They are using someone else's money to fuel expansion while keeping their multi-billion-dollar war chest totally intact.
Okay, so the fundamentals look like a graduation party,
Yeah.
but the debt is just leverage, not desperation.
Right.
But that brings us back to the stock chart, which honestly looks like a hangover. Yesterday, April 21st, 2026, the stock dropped another 3.09% to close at 4.08.
Yeah, the chart is rough.
Why is there such a massive disconnect between the business doing well and the stock price tanking? Stock technicals.
Well, the chart is really just reflecting the uncertainty of that transition penalty we mentioned. The stock is currently fighting to recover from a 52-week low of 3.48 that it hit earlier this month.
Yeah, 3.48 is brutal.
And right now, the technical indicators are effectively gridlocked. It's creating this massive zone of institutional hesitation.
Yeah, looking at the RSI, it's at a neutral 44.75.
Yeah.
So the algorithms are basically asleep.
Exactly. The price hasn't dipped low enough to trigger the automated oversold buying programs that kick in under 30, but it's far from overbought.
It's just stuck in no man's land.
Okay.
I mean, the short-term moving averages are technically flashing by the 5 days at 3.62 and the 10 days at 3.61, but that feels more like a mechanical bounce off the absolute bottom than a real trend.
It is, especially when you see the MACD sitting at negative 0.11, which is a slight sell signal pulling the momentum downward.
And for those tracking the technicals, the MACD is just measuring momentum. But the true gravity on that chart is coming from the 200-day moving average, right?
Oh, absolutely. The 200-day is currently looming way up at 4.98. That long-term average acts as a glaring sell signal, a psychological and mechanical ceiling.
Because large institutional investors use that line as a baseline for trend health.
Right. When a stock is trading almost a full dollar below it, those institutions require overwhelming proof of a turnaround before they commit real capital.
So where does that leave the immediate price action?
Well, immediate resistance is clustered between 4.24 and 4.31, which is approaching the 50-day moving average at 3.98. So the stock is trapped between that resistance ceiling and the rock-solid primary support at the 3.48 low.
Which actually brings up a really fascinating dynamic around that 3.48 level. The sources mention specific order flow mechanics and institutional liquidity grabs happening down there.
Yes, the liquidity grabs.
For a retail trader who just sees the price moving up and down on a screen, what is actually happening in the dark pools in the order books when a stock hits a previous low like that?
Mechanically, what's happening is a calculated extraction of liquidity. Institutions, the smart money, they need to accumulate massive positions, millions of shares, without driving the price up against themselves.
Right. If they just hit buy, the price rockets up.
Exactly. So to avoid that, they need an equal number of sellers. And the easiest place to find a massive cluster of willing sellers is just below a prominent round number or a previous 52-week low.
Because that's exactly where retail traders place their stop-loss orders.
You got it.
If I see the absolute bottom is 3.48, I buy the stock, but set an automated sell order at 3.45 to protect myself in case the floor falls out.
And the institutional algorithms map those exact clusters. They can see the liquidity pooling just below that support line.
Wow.
So the smart money actively pushes the price down. Maybe they short it or just withdraw their own buy orders, allowing the price to drift down and pierce that 3.48 level.
And the second it hits 3.45.
An avalanche of retail stop-loss orders is triggered. It forces retail traders to automatically sell their shares at market price.
And the institutions are just sitting right there.
Sitting right there with their massive buy orders, scooping up all those discounted shares in a fraction of a second before immediately reversing the price upward.
So it's basically like whales splashing around in shallow water to confuse the little fish. And once the little fish panic and drop their snacks, the whales gobble them up and swim away.
That is exactly what it is. It's a brutal mechanism, but it explains why retail traders often get trapped at these lows.
The retail trader gets stopped out, takes the loss, and then watches helplessly as the stock sharply reverses upward.
Right, because the institutional buying pressure suddenly kicks back in.
Okay, so we know the whales are playing games in the short term, but they're buying because they see long-term value, which leads us to the debate. Is this an undervalued gem or a value trap?
That is the big question right now.
Let's look at the analysts. Consensus from 26 different analysts is a strong buy. They have an average price target at 6.29, which is over 50% upside.
Yeah, and JP Morgan just maintained an overweight rating 2 days ago on April 20th, though they did trim their target slightly to 590.
But then you look at the discounted cash flow models, the pure math. The DCF models put Grab's intrinsic value at 11.52 a share.
That implies it might be 63% undervalued.
Why is there such a massive gap? If the pure math says it's worth $11, why do the Wall Street analysts only say 6?
Well, the gap exists because of how DCF models handle growth versus how Wall Street prices in real-world risks. A DCF model is a pretty rigid mathematical formula. It assumes the engine just keeps running perfectly.
So it's a perfect vacuum scenario.
Exactly. It takes that operating cash flow, projects it growing steadily every single year, and calculates the future value. If Grab maintains a flawless trajectory, 11.52 is mathematically justified.
But analysts don't live in a spreadsheet.
Right. Analysts apply a massive risk discount to that 11.52 figure because they know the path forward won't be perfectly linear. They factor in macro risks, competitors, all of that.
Okay, I track the difference between the vacuum and the real world, but I have to push back aggressively here.
Okay, let's hear it.
If the absolute worst-case Wall Street target is still significantly higher than the current 4.08 price, why on earth is CEO Anthony Tan dumping 400,000 shares at an average price of 3.68?
Yeah, that happened on April 10th.
Right. And then 5 days later, CFO Peter Alke sells 50,000 shares at 3.92. If the DCF model says 11.52 and the CEO is selling at 3.68, that looks like a massive red flag for a value trap. You don't sell at the absolute bottom if you actually believe your company is 63% undervalued.
I completely understand why it looks that way. To a retail investor, the immediate assumption is that the executives see the ship sinking and they're cashing out.
Exactly.
But we have to look at the context and the mechanics of executive compensation. These were planned divestments. They were executed under 10b5-1 plans.
Wait, the predetermined trading plans?
Yes. It operates less like a captain abandoning ship and much more like a thermostat. Executives are compensated heavily in stock options, which create huge tax liabilities.
So they have to sell to pay the IRS.
Right. And to prevent any accusation of insider trading, they file these 10b5-1 plans months or even years in advance.
Oh, so Anthony Tan didn't just wake up on April 10th, look at the falling chart, panic, and hit sell.
Exactly. A computer program blindly executed a contract he signed a long time ago, completely regardless of what the stock price was doing that day.
Okay, so the machine just executes it.
Yeah. And honestly, holding 100% of your net worth in a single volatile tech stock is just terrible portfolio diversification, even if you are the CEO. So they sell to diversify. It doesn't necessarily signal a lack of confidence.
Okay, fair enough. So if the insider selling is just paying taxes and diversifying, what are the real landmines here? What are the best and worst case scenarios for this stock going forward?
Let's start with the bull case, the recovery scenario. This is heavily built on the foundation of their first fully profitable year and a massive $500 million share buyback program they just initiated to support the price.
A $500 million buyback. Let's break that down, because a buyback is different from a dividend.
Very different.
How does that actually support the price?
A buyback reduces the outstanding float, the total number of shares available to trade. When Grab takes $500 million of its own cash and buys its own stock, it retires those shares.
Right, shrinking the supply.
Exactly. And by shrinking the supply, every remaining share represents a slightly larger percentage of ownership. It makes the stock mathematically more valuable. Combine that with their successful geographical expansion into Taiwan, and you have a very robust foundation for recovery.
Okay, that makes sense. But then we hit the bear case, the continuation lower. And this brings us right back to that transition penalty.
Yep, here it comes.
Grab's revenue growth is decelerating. They hit 20% growth this year, but forward projections show it stalling in that 20 to 22% range, which is actually slower than some smaller competitors.
And that is a dangerous transition period for a newly profitable company.
Why is that so dangerous? 20% growth sounds great.
For a mature industrial company, yes. But for a super app, the second your growth slows down to 20%, investors stop valuing you entirely on your total addressable market and future potential.
They stop giving you a pass on the money you're burning.
Exactly. They instantly start demanding flawless execution on margins. You're no longer judged on how fast you can grow. You're judged on how cheaply you can deliver a ride or a meal.
And if you're a retail trader, This is where you get caught. You see the profitable headline and you jump in, but you ignore the slowing growth and the macro risks,
The macro risks are huge here.
especially their exposure to oil price volatility. If oil prices spike, Grab faces a brutal choice. They either eat the increased fuel costs to subsidize their drivers, which destroys their new profit margins,
Right.
or they pass the cost on to the consumer through higher fees, which suppresses demand.
It's a lose-lose scenario for their margins, but honestly, the far more systemic risk looming right now is the regulatory shift in Indonesia.
Oh man, Indonesia. Break down why Indonesia specifically has the power to derail this entire operation.
Well, Indonesia is the crown jewel market for any Southeast Asian super app. But currently, Grab's entire margin structure there relies on gig worker classification.
Meaning the drivers are independent contractors.
Exactly. Which means Grab avoids paying traditional benefits, healthcare, overtime, all of that. But the Indonesian government is heavily scrutinizing this model.
Wait, really? What happens if they change the rules?
If regulators reclassify gig workers as formal employees, or if they implement strict legislative caps on the commission rates, Grab can charge restaurants. The underlying math of the company fundamentally breaks.
Wow, so those operating costs would just explode overnight.
The $65 million in positive operating income they just fought years to achieve would be instantly wiped out by new labor compliance costs.
So that profitability is actually highly fragile.
Highly fragile. And the market is pricing in the fear that this favorable, unregulated labor environment might not exist in 2 years.
Okay, bringing all of this data together, what is the ultimate outlook for the listener who is just trying to make sense of this mixed bag?
You really have to summarize it into a dual outlook. The short-term perspective is undeniably bearish.
The technicals are just too heavy.
Right, the forecasts predict a further slide. We're likely going to test that 4.03 to 3.93 range in the coming days as institutions hunt for deeper liquidity.
But the long-term perspective.
A long-term perspective remains heavily bullish, assuming they navigate the transition, with targets of 6.37 or potentially higher by 2030.
So we've talked about the algorithms, the buybacks, and the whales manipulating the order books. But the real wild card might just be something the pure math models can't perfectly price in.
Human behavior and legislation.
Exactly. Are those regulatory shifts in Indonesia the real sleeping giant that could unravel, Grab's margins, or just a temporary speed bump on the road to super app dominance? That is something you'll have to keep a very close eye on.
Definitely.
Thanks for diving deep with us today.